There's many factors contributing to how difficult this market is right now. So many, in fact, that it gets pretty confusing. You've got war, you've got inflation, you have supply chain constraints, you have high gas prices, you got interest rates rising, you got this and that and the other thing, and it all kind of coalesces into the idea that we are heading for a recession. And we've made many videos about this, including that Druckenmiller video that you saw recently. But hey, we know how markets work, right? If everyone is thinking recession, that actually increases the probability that we don't get a recession. So in this video, we're going to look at the possibility of not having a recession and of course, what's going on in the market right now. So recently, Alex, who's our lead researcher in macro ops, he was talking to his mentor and friend, another member of the macro ops collective. And this guy has worked with some of the most legendary names in the industry and now is semi-retired and running his own family office. He's one of the best traders we know and he has over 30 years in this game. So Alex talks to him every few weeks and they catch up and they talk about markets, of course. So here's kind of a paraphrasing of their conversation. Now, of course, I'm not giving his name because he likes to be private, but we'll go over the important stuff that pertains to the market. So he thinks markets are likely toast, probably for the rest of the year, at least through summer and into fall. Because inflation, what we're dealing with, is really a political problem too, and it's a big one with midterms coming up. So that's why Powell was called over to the White House with his hat in his hand back in May. Inflation is too high and the buck has been passed to the Fed to fix it, and they only have blunt tools to do the job, all of which are basically to hammer demand until something breaks. And that's basically what they told us at the last meeting, right? They basically said that they intend to push us into a recession in order to try and bring inflation down. And yeah, that meeting was aggressive. And it's kind of funny because the Fed is basically saying that, hey, inflation is too high, so let's make sure people don't buy stuff anymore. Let's make it really difficult for them by increasing interest rates. Literally aggressively trying to tank the economy just to tamper down inflation. And they've made it very clear that they're willing to do what it takes to have that happen. Now, considering that, the delta on inflation has likely peaked, meaning like the rate of change in inflation. And also this fits into what we talked about with peak inflation. So if you remember the last time we thought the market might have a potential bottom, that inflation reading came out that blew out all of everyone's expectations, analysts and our own as well. Because people talked about the peak inflation narrative, right? Maybe we were heading there. Everyone was so worried about inflation, but it might not be as bad as people thought. And given how markets work off expectations, if it's not as bad as people think, then what's going to happen? You're going to get a rally in the stock market. But in fact, it was worse than what people thought. So now we're kind of on the other side. The pendulum has swung the other side where people are expecting really, really bad things. And this time, hopefully the next inflation print will come down below expectations. So that's what we mean by the delta on inflation has likely peaked. And not only that, but supply pressures are easing and demand will continue to soften dramatically. But the problem is that the Fed is going to need consecutive months of lower inflation before they can even begin to signal a slower pace of tightening. So it's not like we're going to get one decent inflation print that's not as bad as we thought and the Fed is just going to reverse course and say, hey, we're going to be done tightening now. No, they got to keep doing it to keep inflation lower because inflation doesn't go away overnight. So given that the Fed is going to keep tightening, it would be a tough time to buy equities right now. And he doesn't even necessarily agree with all the recession calls for this year, at least not in the US. Europe, yes, definitely, they're in trouble. And they're probably already in one. But while the US may not enter a technical recession soon, it will feel like one. But if we do enter one, it will probably be short-lived and fairly benign. The fiscal imbalances just aren't there. And quite a bit of air has already been taken out of this market, which we all know we've fallen a lot by this point. It's been brutal and fast. So at this point, it's kind of hard to break your legs when you're just jumping from a second-story window. I like that analogy. And another thing to consider is just how much cash households are sitting on right now. Look at this. This is the most cash that they've sat on in years. And a lot of it accumulated during that pandemic period with all the government stimulation. And this is what we were talking about when we said previously that we didn't think a recession was coming because household balance sheets were so strong. And by the way, these numbers are coming from Ben Carlson now. So before the pandemic, US households never experienced anything like the increase in cash they experienced over the past 2 years. And this remains true even after we adjust for the run-up in inflation. Like, look at this. This is a big increase in savings. And the point of savings is that if you go into a recession with that much savings, you might be okay. Not only that, but if you're in an inflationary period where you would think people would stop spending, if they have all this money saved up, maybe they keep spending. And those factors going into a recession will make the recession a lot less worse than it could have been. And you know, a lot of people would think, okay, it's mostly the wealthy households that are hoarding cash, but that's not actually the case. See, people in the top 10% by wealth held 32% more cash and cash equivalents in the first quarter from 2 years earlier, but people in the bottom half held 45% more. So the growth in cash levels is across all the levels of wealth, not just the rich, which is important because the bottom half is the one that actually stimulates the economy because they're spending money. Even total wealth has exploded since the onset of the pandemic. So total household wealth increased from 109.9 trillion in the fourth quarter of 2019 to 141 trillion by March 31st, 2022. That's a 30% increase. Households have never been richer. Another thing we could talk about is housing, right? Because a lot of people's wealth is in their house because it's such a big purchase, obviously. And you can see here housing debt service as a percentage of disposable income is off the floor, but still lower than it was between any time from 1980 to 2020. So a lot less percent of disposable income is going to housing right now, which is good because that means that people have more money to spend in the economy. So their debt service payments aren't weighing them down. Same is true of mortgage debt. Mortgage rates and housing prices are now much higher, so you would expect this number to rise in the coming months. But those who already own a home are in a much better position than they were during the last housing bust. And again, this is US mortgage debt service as a percentage of disposable income, very low. And just compare right now versus 2008, the real housing crisis. Look at the distribution of people getting loans. If you're a credit score of 619 and lower, 2% of those people are getting loans in 2021 versus 14% in 2006 leading up into that bubble. And look, 760 and higher, 70% in 2021. That's all the people with good credit. They're the ones getting the loans. This was only 24% in 2006. So there were 7 times as many subprime borrowers who have a 619 score and lower getting loans in 2006. But last year, like we just said, 70% of the mortgage originations were from households with excellent credit scores versus only 24% in 2006. So the biggest problem with the last housing bubble was that it was a subprime housing bubble. People with poor credit were taking on these loans they couldn't service, and then their teaser rates rose on adjustable rate mortgages, and when their housing prices fell, it was a double whammy. So they were underwater on their house and they couldn't make the payments anyway, and that leads to the big bubble. But things are completely different right now. Homeowners have a record amount of equity in their homes, and a lot of solid wealth has been built from these homes increasing in price, while their interest rates were so low, so they're not paying that much debt on them. And they're just better loans, more responsible people. It's not like the 2008 financial crisis. So a vast majority of borrowers have equity in their home, fixed rate financing, and a low borrowing rate, which is good. So even if people see the value of their homes decline in the coming years, there's a huge cushion, and they don't need to worry about their mortgage rates resetting. Just a much better situation with people with more money on their balance sheets, their household balance sheets. So even if we did go into a recession with all this inflation, we might keep spending. You can look at some more stats. Airports are now at their highest levels of passengers since the pandemic started. And this is even more impressive when you consider that business travel is still down 30% from pre-pandemic levels, because we all use Zoom now. There are lots of people traveling and spending money right now. And they're in good enough shape that we could potentially put off a recession for a while longer if people simply keep spending through the inflation. And even if we do go into a recession, there's a high probability that the downturn could be minor because consumer balance sheets are in such good shape. So considering that, will we go into a recession? It's still a maybe, of course. But based off how our balance sheets are looking, how much money everyone has, how the last 2 years have been so good, which is crazy, right? Because it was a pandemic. It was just a crazy period. The coming recession may not be that bad. And make sure you're subscribed to the channel if you're not already, because we are releasing a video in a few days about how long bear markets usually last. Because we could talk about recessions in the economy, and we could also talk about what stock prices are doing. They don't go hand in hand all the time. And obviously, as traders and investors, we want to know how long will stocks keep going down, or how long will we deal with this volatility? So that video is coming out in a few days. Some nice stats in that video. But going back to what our friend said, it kind of lines up. He says if we do enter a recession, it'll probably be short-lived and fairly benign because the fiscal imbalances aren't there. And we've already fallen so much in the market. And a lot of people's wealth is based off the stock market, right? Even all our 401ks and all of that. You see it down, 30%? Takes a hit. It does affect your finances and what you're spending on. So the worst may have already came. Maybe. So profit margins for companies are still unsustainably high and are about to get squeezed. Earnings are coming down while estimates are ridiculously elevated, as you pointed out the other day. And he's talking about this chart right here that we published in the Dirty Dozen the other day. And you probably saw in our Tuesday video. You can see the S&P has fallen like crazy, but earnings estimates, they still have some ways to go. And they do follow each other. So basically analysts need to revise what they're thinking, and they're always behind the curve anyway. But that's what he's saying by margins are going to get squeezed and estimates are elevated. They need to come down. And analyst estimates and everything are important again because markets work off what? Expectations. And that's a good gauge of what expectations are. So again, when you see a stock, right, and their earnings come out and they miss earnings, it means they missed what was expected. And then the stock price falls. If they do better than what was expected, the stock price rises. So it's all expectations. But all in all, it's a messy and noisy environment. It's not a great risk to reward trade here. Our friend here is not even sure that he buys into the new secular inflationary regime. This is not the 70s. The demographics and debt couldn't be more different. But this also isn't the last 30 years either. So you can't really be sure of either scenario. The politics have also changed dramatically. Politicians have now discovered fiscal, just like when they were giving us free money in the pandemic, right? Those were fiscal moves. They can make laws. So that's kind of a Pandora's box that's been opened and won't be closed anytime soon. Right now, 30-year mortgage rates are over 6.25%, which is going to freeze the housing market, which we've already seen signs of. And US equity allocations are just coming off their all-time highs. And if we are in a long inflationary regime, well, that's going to come down a lot more. So that's where our friend here is thinking where we are. Now, could he be wrong and we hit a cyclical bottom next week? Yeah, that could happen. He's wrong all the time, just like all of us, and just like all the greats. That's why we rant about risk management on here, because it's okay to be wrong as long as you flip to the right side and then make money. He said that this is one of the more exceptional macro environments he's experienced in his 30 plus years in the market. So we gotta be flexible. To him though, the rest of the summer is at the very least going to be messy. He doesn't see the light at the end of the tunnel yet. Sure, markets are deeply oversold right now, which if you've been watching our videos, you know we've been tracking the sentiment and positioning, and it's very, very bearish. But keeps falling, right? And that's the thing with sentiment and positioning. You just can't use it by itself, because what's bad can get worse. But markets are deeply oversold and multiples are a lot more reasonable in aggregate. So we'll probably get some large rallies here and there. But he doesn't think the bottom is in. Far from it. He thinks we probably have another year of a slow grinding bear. And remember, subscribe for that next video because we actually got the stats of the probability of how long this bear market will continue. So he's thinking this is more like the 2000s instead of 08 and 09. In the 2000s, we did have a longer bear market. You'll see in that video, it was like 3 years. Rough. 08, 09 was faster. But he doesn't see any systemic liquidity risk this time around like 08 and 09. So in his mind, now is a good time to get out and just enjoy life. Go read some good books, get a tan. Don't just be chained to your computer this whole time, because it's not often that markets give us a chance to take an extended vacation like they are now. Success in this game is about long-term compounding. And there's layers to that, which includes giving yourself a break and stepping away from the screens. Helps keep you fresh. His ability to do that and his learning to do that is one of the reasons he's still around now, still playing this game after 3 decades. There might be a better market to come back to in the fall, but maybe not. We'll just have to see. And we've talked about this on the channel many times. During a bear market like this, it's not the end of the world. Your world isn't this computer screen and the numbers on this screen. So again, now is a great time to take a step back, go do something else, because you still should enjoy life even in a bear market. And in Alex's case, he feels a bit more hopeful than most when it comes to the recession, because right now it's such a crowded narrative. And of course, Alex and myself too, we're all contrarians. So we naturally feel like taking the other side, which you've got to temper as well. But if we look at the data, 5-year forward break-evens are already coming back below 2018 levels. Freight costs are plummeting, shipping and delivery times are coming down, commodity prices are falling, and every retailer over-ordered, which means price cuts are coming. But of course, when you zoom back and you see that households have a record amount of equities, right? But they built that up when inflation and yields perpetually trended lower, with dampening volatility, but that's no longer the case anymore. Our demographics are no longer deflationary. We have populist politics, we have deglobalization. We have to be open to the idea that we're in vastly new terrain going forward. It's about to be the decade of macro, I can tell you that, because things are going to be different. And that's why it's so difficult, like when you see the news saying, of course a recession is going to come. That might not be the case. We might not get the recession, or if we do, it might be a slight one. It's a very complicated time period. But that's why you're here. That's why you're with Fallible and Macro Ops, because we're going to help guide you through it. And while we're in this bear market, one of the most important things you can do is risk management. And we just made a video about it here, risk management and position sizing in a bear market. Definitely check out that video because that's what you need during times like this. So click this video right here and I will see you there.